Hello friends, how are you doing out there? Last week in my video, I discussed whether I would buy at the present levels. I gave you a checklist of 5 items and I told you at least 3 if not 4 need to be met before I would go out and buy. Now if you adhered to that checklist, you would have saved yourself a lot of pain and heartbreak. Now in this week's video, what I want to discuss with you is there has been short selling at higher levels, and I'm going to present you weight of evidence to that extent. Whether the short sellers are likely to get squeezed out of their shorts, will they be forced to cover their shorts, and will the markets go up? What does the market data suggest? And that's what you know me for, data-based, evidence-based analysis. Now friends, I've recorded a special segment at the fag end of this video just before I share my trading strategy for the week. So please stay with me till the end of this video. Right now, let's dive right into our usual market roundup window. And what you can see is that the Nifty 50 just about managed to gain for the week, whereas the Bank Nifty was where all the action lied. Do remember what I've been telling you since many weeks. This is a game of weightages. If at all the market has to go up, the banking segment has to go up, without which there will be no rally for the sheer weightage of 34% plus of banks and financial sector stocks in the Nifty. The next three sectors, the next top 3 weighted sectors put together do not provide the same kind of weightage as banking provides. So are you now really surprised as to why banks are going up? Hey, I'm not. And I'm glad we are learning how the market tricks people. The US dollar index went up, and that pushed bullion prices lower because the dollar is the invoicing currency out here. Natural gas prices fell. I told you the spike last week was due to rollover considerations and the rollover premium. Crude oil went up due to cyclical reasons of the hurricane season beginning in the United States, and the USD INR, which is the dollar versus the rupee, basically rose 26 basis points. That tells you that the rupee actually weakened. Last week, the rupee hit an all-time low against the dollar. The 10-year benchmark bond yields fell by 1 basis point. That means bond prices went up. This was one of the few reasons why banking stocks went up. NSE just about lost a little bit in market capitalization, so the nervousness was across the board. MWPL or market-wide position limits went up routinely ahead of the expiry that comes in the week ahead. The United States markets indices went up, providing tailwinds to our markets here. Friends, let's take a look at the sectoral performance, the index performance rather. You are seeing that the Bank Nifty is now outperforming the Nifty 50 over a 4, 12 and 20 week period. Like I said, this is nothing but a play on weightages. Unless you push banks higher, you're not going to be able to see any kind of a rally in the broader markets. Let's also take a look at the ratio charts here. Now, what do the ratio charts tell you? Now, in this ratio chart, what I have done is taken the Bank Nifty as a base and divided it by the Nifty 50. What you are seeing is a humongous 3.16% gain in the Bank Nifty ratio versus the Nifty 50 last week. And we are now at the highest point where this ratio was in calendar year 2024. That tells you that somebody knowledgeable is really pushing up banking stocks to push the broader markets higher. Nothing happens in financial markets without a reason, and hey, these are financial markets, so the reason is also financial. I also tell you that WYSIWYG, what you see is what you get, is a myth in financial markets. Believe in WYSIWYG at your own peril, and here you're seeing it play out right in front of you. Friends, our weekly market roundup done. Let's now go to our in-house indicators. I start with the MWPL, and what you are seeing is the MWPL hit another high at 42.22%. It's the second highest, but do remember MWPL normally peaks on a Monday or Tuesday in the expiry week. So we still have a shot at 43.44% a peak reached in the derivative series of May. Will it go there? Time will tell. But look what's happened here. Post expiry of May, MWPL collapsed to 28.55 from 31.17 post expiry April. So just when people thought risk appetite was shrinking, MWPL scaled 42.22%. So risk appetite has gone up, but high MWPL also means that larger positions will get reversed if there is any negative news coming in. So that leaves you with the possibility of a crowded exit, which is why volatility has risen. Let's now come to the turnover. Turnover actually went up in both the stock and index futures, in spite of the fact that the week was shorter by one trading session. That means on lower levels, there was participation. Traders were actually shorting the markets. Friends, let's now come to the advanced decline ratio, which after the price itself is the most leading indicator. This is an average of all 4 trading sessions of the week. The Nifty logged 0.15% gain last week as compared to 1.79% gain in the prior week, but the advanced decline ratio fell sharply to 1.11 from 1.71 in the prior week. What does it tell you? It tells you that for every 100 losers, there were only 111 gainers. But the bulls still had an upper hand. Friends, now I come to basis and pay particular attention to this. If you wanted any evidence that there is short selling happening, here it is. The basis is inverted on both the indices, which is not very common to see in the markets. What is meant by basis inversion? That means a future is trading at a discount to spot. What is the implication? Please stick with me till the fag end of this video. I told you there's a special segment on will short sellers get trapped in the coming week. There I will explain to you what the implication is. But for now, just be aware that basis is inverted, short sellers are hammering. Now I come to our in-house indicator, the impetus, which you've been enjoying since over 3 years. And what you are seeing is both the indices have seen a sharp fall in the impetus, even though the indices clocked week-on-week gains. That tells you that momentum was very weak on the upside in buying. Even the Bank Nifty, which saw large gains last week, is seeing impetus come down humongously. That tells you that bulls were lacking conviction at higher levels. Friends, I now come to another in-house indicator which you won't get anywhere on the internet, the lift, weight, thrust, drag indicator, which you've been trusting for over 3 years now. Take a look at what's happened. The Nifty clocked 0.15% gains, but the LWTD fell from 0.46 prior week, to 0 last week. That tells you that the LWTD is indicating neutral stance. It's neither here nor there. But the fact remains that it's come down from a 0.46 tells you that momentum has eased. It has fallen. So it could go anywhere. But this is the weekly chart. If you had been watching the LWTD on my social media accounts on a daily basis, which I put up late every evening, you would have seen that the daily LWTD has been constantly falling. So please do connect with me. Here are my contact coordinates. My Telegram channel is one-stop shop. It's absolutely free, and I put up all my research, my thoughts, my inputs on this channel first, foremost, and always. Friends, our in-house indicators done. I now come to the bond market, which is very close to my heart. And what we saw last week was the Indian 10-year benchmark bond yield came down by 1 basis point, which means bond prices went up a little. Now, that tells you that there was a mark-to-market gain on bonds for banks who are the biggest investors in bonds. Fair enough, that's good. But what happens to the gilt funds that we exited rather prematurely, as you would feel in hindsight? Because gilt fund NAVs have risen after we sold. Why am I not advocating a fresh entry into gilt funds? Now, let's not make any political statement out here. I'm talking as a pure finance professional. Now, the point is that there is a coalition government and there are pulls and pushes on a coalition government, which means there is a probability. I'm talking of probabilities, not of guarantees. There is a probability of higher social welfare spending. All that the bond markets need to hear is, hey, we are going to borrow more money from the bond market to meet these social welfare expenses. And bang you go. Bond prices will come down and bond yields will start to rise again. And your gilt fund NAVs will progressively fall. Now that is one possibility which I'm guarding you against. But if you feel you should go ahead with gilt funds and invest because the train is leaving the station, hey, it's your call. Do remember that the USD INR, the rupee versus the dollar, is testing all-time lows, which tells you that inflation metrics are not exactly in our favor. So I'm playing it safe. I'm avoiding gilts right now. Friends, the bond market's done. I now come to the Bank Nifty, which was the star of the week gone by. And do remember what I told you. It's all a game of weightages. Now take a look at the daily chart on your screen. The Bank Nifty has clocked gains on 3 out of 4 trading sessions. And that basically tells you that bulls were clearly very, very cheerful out here. Ending the week with a bearish hammer, which indicates caution. The hammer high is at 51,935. Now this high needs to be overcome on a sustained closing basis if the short-term momentum is to sustain and bears are to get squeezed out of their short positions. The price is above its monthly average, which itself is pointing upwards, but the difference between the price and the monthly average is rising. So mean reversion could occur. What is mean reversion? Consolidation. The price goes sideways and the average catches up with the price, or price might even come down towards the average. Let's now move to the weekly chart, which shows a power candle that finally overcame the peak made in the election result week's top. The bullish wedge has also been overcome as a resistance point. Now, this is what I have been alerting you about: weightages and the games that weightages will play in the market. Never ever take statistical weight of evidence lightly. Now, the price is above its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost. So, the medium-term outlook is positive for now. Friends, in the week before last, this index was number 3 ranked on a statistical beta basis in the most volatile counters list. It remained at number 3 itself, so challenge level remained higher. Last week, I advocated an estimated range between 51,625 on the upside and 48,375 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 53,300 on the upside and 50,025 on the downside. Friends, please also check out our daily, weekly and monthly pivot levels, only available on our free Telegram channel. You know the contact coordinates. These pivots will help you laser precise your entries and exits. Friends, the Bank Nifty done. I now come to the Nifty 50, which just about managed to keep its head above the water, and that too all thanks to the rise in banking and financial stocks. Now, if you're a thinking trader, you would have immediately guessed as much, because I've been harping on the weightage game since many weeks. The price is above its month-long moving average, which itself is rising higher, and both the Nifty and the Bank Nifty are at all-time highs. So overhead supply, which means selling by traders who've got stuck at higher levels, is unlikely to come. But short selling is another matter altogether. Now please watch the short selling segment very carefully at the end of this video. That will clarify matters for you a lot. The difference between the price and the moving average is rising, so mean reversion is getting possible and higher probable in the days to come. The weekly chart shows a tiny bearish spinning top candle which shows indecision. The candle top is at 23,667 level, which must be overcome sustainably in order to push the bears into cover their shorts. The price is above its 25-week exponential moving average, which itself is higher, but the gap here also is widening between the price and the moving average, so consolidation is getting likelier. Now, in the week before last, this index was number 9 on our most volatile counters list based on statistical beta rankings we maintain in-house. It fell sharply to number 21. Why did that happen? The range was narrow. Individual stock movements were much more higher. So relatively speaking, Nifty's volatility or intraday statistical beta fell. Last week, I advocated an estimated range between 24,100 on the upside and 22,850 on the downside, which held perfectly well. In the coming week, I estimate ranges between 24,100 again and 22,900 on the downside. Now, this small change is because of the small base effect of the intra-week range last week. Friends, a reminder here, in addition to these levels, please also check out our daily, weekly, monthly pivots on our free Telegram channel. Friends, before I proceed with this video, a very important message for your and my safety in the markets, please. Me as an individual and our family companies, including Bhambwani Securities Private Limited, our proprietary firms, our family trusts and HUFs, etc., do not, I repeat, do not provide any paid services whatsoever. We are not brokers, we are not distributors, we are not advisors, we don't provide any paid services. It has come to my knowledge that people are being approached by somebody claiming to represent me and my companies. This is not a genuine person. Whatever is the number for the police helpline in your city, if you get a call representing us, call up the cops, get that guy arrested, show me a picture of the FIR and the guy's mugshot, and you're welcome to have lunch and dinner and drinks with me at my club the next time you're in South Mumbai. Friends, I now come to the last bit of statistical analysis wherein I analyze the footprint of the retail risk appetite as contributed by the turnover in the 4 segments in the derivative space. The index futures turnover went up 0.03%. It is represented by a blue line. Stock futures turnover went up by 0.15%, indicated as a red line. So, relatively speaking, risk appetite was up. Futures cost more money. Span margins, mark-to-market margins, concentration margins, and extreme loss margins, etc. In spite of that, traders were playing more in futures. So risk appetite and hope is up. Now, where index options turnover is concerned, these are the least risky and most cost-effective as margin goes for traders. Their turnover actually fell by 0.70% and is indicated as a green line. Stock options turnover went up by 0.52% as indicated by a purple line. So the lion's share of turnover increase has come in stock options. That is a lot more risk averse than stock futures. So risk appetite has gone up, but it has gone up in small measure. And if at all the bears are to be forced to cover their shorts, risk appetite must go up significantly more. Now, friends, the promised segment of whether the bears will get a hammering by the bulls. Now, the basis chart. I come back to the basis. What does it tell you? Bears have hammered the indices into basis inversion, which means the futures are trading at a discount to spot. They are actually paying for going short since they are selling at a discount. Now, I'm hearing a lot of non-trading perma bull experts get all excited on social media about how bears are walking into a trap by shorting at discounts. Hey, wait, check out this video wherein I have with statistical evidence proved to you that bears actually tend to have an advantage over bulls thanks to the interest component that short sellers receive over a period of time, and because markets tend to fall faster than they rise. So it's not a fluke that the basis is inverted. Bears know what they are doing. It's a very calculated move. Will they get caught unawares? Will they be forced to cover their shorts? Yes, we'll take that as this segment progresses. Now, in order to push the short sellers to cover their shorts in panic, bulls will have to do what the armed forces do to enemy forces. They encircle them, leave them with no way out, and force them to surrender with threats of death otherwise. So, bears must feel a great deal of fear. And why will they feel fear? Because prices are rising. The bulls must push prices constantly higher to make it very expensive for bears to continue their shorts, which means bears must be pushed into paying mark-to-market losses day after day, so that they start getting nervous and sweat from under their collars. This is what one segment of the market does to the other to win. Push the losing guy into paying mark-to-market losses. Have you seen the state of what is happening to copper? I have been telling you I don't believe in super cycle in commodities, whether it's oil and gas, whether it's metals, right? Apart from bullion, which I'm very bullish on, I'm not a super cycle believer in energy or industrial metals. Now, I've been talking about copper on my Telegram channel. If at all you are a believer in a super cycle in copper where the theory is that copper prices will double in 10 years, fine. It's a non-deliverable item in the Indian commodity exchanges. So for 10 years, are you really going to pay rollover charges? Will you actually make money after paying rollover charges for 10 years to the financer? This is what I have been telling you in this video. People do not take seriously the interest component paid by a bull to go long, and he winds up working for his financer. But that's not enough. For every 1 rupee fall in the price of copper, the market lot is 2,500 kilos. You wind up paying 2,500 rupees M to M. And you know what copper is down by? 100 bucks. So for every 100 bucks, you are down 2.5 lakh rupees in mark to market. Even though you might be convinced that copper is going to go up after a decade, in the interim, you'll wind up paying lakhs and lakhs in terms of rollover costs and mark-to-market losses. That will break your conviction. This is the kind of breaking of conviction that bulls will have to do to the bears in our stock markets and in the indices so that the bears are forced to cover their shorts. Now, will there be any signs that bears covering their shorts in panic? Hey, yes. I'm a statistical systems trader. I don't talk anything out of thin air or under my hat. I will give you statistical weight of evidence and teach you how to observe this evidence. Open your snapcode window on any desktop trading terminal. Most probably the syntax is highlighting that stock or that traded script and clicking on F5. F for father, F5. You'll see the snapcode window open up. Now, on the left-hand side are the bidders or buyers. On the right-hand side are the sellers, and these are offers. What will happen when bulls will start pushing bears into covering their shorts? You will see that the guys in blue on the left-hand side will aggressively raise their limit prices and buy at whatever prices these sellers are offering the stock at. And that will panic the sellers. And they from the right hand side in red will come to the blue and turn to become buyers and square up their shorts in panic. Now when bears start to become buyers by jumping from the red side to the blue side, you will see that the refresh rate on this snapshot window suddenly start going haywire. It will become very, very fast. What are the other signals? Take a look at the LTQ, the last traded quote. The LTQ will invariably stay higher above the ATP, which is the average traded price. It's all there on the snapshot window. It's not rocket science. I'm not sharing any big secret with you. You should know it by now. Hey, you want to be Mr. Professional Trader? These are tricks of the trade you need to know. All right. And not only should the LTQ be above the ATP should be above the previous day's close. So you see how it's like a staircase with each progressing step going upwards. Now this is all there on your trading terminal, both on the mobile and on desktops. But here, let me show you another study which is exclusively desktop trading terminal based. You see this tick list? I keep talking about the tick list a lot on my Telegram channel. I've even shared a few tick lists of few individual stocks. When you open this tick list, you will see that at some price point, now what you see in this tick list is date and time stamp, price stamp and quantity stamp. Once in a while, you see a spike in traded quantity. You need to observe as a professional trader, keep your eyes peeled open. What happens after these big quantities are traded? Is the price going up, which means there were buyers? Or is the price going down after these big quantities because there were sellers involved there? Are you actually going to tell me that in spite of having all these tools at your disposal, you're still seeking magic wands from people who may or may not be professional traders? And you're listening to a hell of a lot of talk, which may just be that talk. And hey, talk is cheap. Don't listen to talk. Listen to statistics. Statistics don't lie. People do. So I would rather listen to my trading terminal and close my ears to all the noise around me from everywhere else. That is how you're going to get in the driver's seat and take charge of your money and your life. Learn all you can about screen reading, and believe me, you'll thank yourself for it. Your family will thank you. Now, the other thing is the checklist of 5 items that I shared with you. Do you know an airline pilot has a checklist? Before he takes off, he has to tick mark everything. Tire pressure, okay. Fuel, okay. Oxygen in the tanks, okay. Air conditioning, okay. Everything. Unless the tick list is completely checked, all the boxes are checked, the air traffic control or the ATC will not allow a pilot to go on the runway to taxi for takeoff. This list of 5 items is my checklist. Unlike an airline pilot, you need not want to have all 5 items ticked here, but minimum of 3, if not 4. I prefer 4. At least 4 should tally, which it did last week. Apart from MWPL, we saw everything else go underwater, especially the USD INR. That worried me because we hit an all-time low against the dollar. Right? Now what happens if the checklist is not met? What if the bears are not being forced to cover their shorts? What if the indices are still witnessing basis inversion in spite of the fact that we are heading towards expiry? In the expiry week, normally people tend to square up their positions. Some of them roll over their positions also, but bears normally tend to square up their position. So if bears square up their position, the inversion should reverse into a positive carry cost. If that doesn't happen, what do you do? If bears are forced to cover their shorts, you're happy because your existing stocks will go up and you'll probably wind up buying some more. But hey, let's keep plan B. What if it doesn't happen? You saw this video? How do you make money? Theta decay on options. Take a sweetheart deal, write that option and sit tight. In a series of videos that I will be uploading on options trading, yes, again, free. I don't charge money. I don't provide services. All I ask from you, is to please share my work with your family and friends and your social media groups and circles, etc., so that my work is spreading the knowledge and light of basically statistically sound system so that people don't lose money out there. All right. So I will start resorting to theta decay option writing so as to earn above normal or above a bank FD rates of returns and sit quiet. Another aspect that I will watch is the price. Price to a trader is God. For me to feel that bulls are punishing the bears by forcing them to cover their shorts is the price should start going up consistently with high volumes. And if this is a previous high, the price should smash past this high with high volumes and leave no chance for the bear to wait for a pullback. When that happens, when the glass ceiling cracks, what really happens is the bears are punished. They start to panic and they run for cover. And remember, your snapcode window will start seeing refresh rates jumping very, very fast. The guys from the red corner will come to the blue corner. It will show up as the total number of outstanding trades below the best five bids and offers. Those numbers will change drastically. Listen to the market because the markets talk to a trader. But he who pays the most attention is the guy who takes the prom queen home for a dance. You can't be listening to third parties who may or may not be traders. Stay safe. Remember, there's no urgency in a trader like a trader who's losing money, big money, and therefore he's panic struck. He will want to get out because the mental stress of that losing trade will force him to get out in a hurry. You and me want to take advantage of that situation, both on the bull side and the bear side. I've shared with you a secret of MWPL. I target stocks where MWPL is huge. A lot of people have built up a lot of emotional and financial commitment into stocks. And if I feel any one side is going to get trapped because positions build up are huge, I would trade on that side using both linear futures and non-linear options. And I would sit quiet like a fisherman, putting my bait and waiting for some fish to bite. Admittedly, these trades don't happen every day and you may have to wait for a while before profits come. But come they will, and big time. Bread, butter, jam and chocolates all in one shot. So be very careful. These are not markets that you want to trifle with. Derivatives trading is always very risky and substantial losses can occur. Now friends, for my strategy. Firstly, I will maintain my tail risk hedges. I'm not trading without them. The statistical beta is way too high for my statistical comfort, so I'll play safe. I remain focused on public sector units like oil marketing companies, public sector banks, power generating, power transmitting, railway companies, and these will give me two-way action, both on the bull and on the bear front. So I, as a trader, am agnostic. I will go whichever side the market tells me to go. I think bullion will remain supported on declines, and industrial metals, which will probably see selling on rallies, if there are rallies, by people who are stuck at higher levels, and they will provide overhead supply. Why am I telling you that? Because this will have a direct bearing on stocks of metal mining companies. They will also feel higher volatility coming in. I continue to seek theta decay in oil and gas, which I see cyclical bullishness thanks to the hurricane season starting in the US. Now here, hurricane season starts from June and ends in October. Sometimes it stretches to November, and you're going to have echo chambers of Parma bulls coming out and shouting, hey, it's a bull market, it's a bull market. But these are weather-related disruptions. They don't last. So I basically target the FAR month futures, take a pot shot and sit quiet with a mug of coffee and watch the fun and games. I resort to linear futures and non-linear options combinations to A, earn rollover costs on futures, and B, earn interest to fund mark-to-market losses, if any, and if not, then get some extra bang for the buck on my cup of cappuccinos. Friends, if there are any more ideas I feel like sharing with you, I will be gladly sharing them on my Telegram channel first, foremost, and always. I thank you for your patience in being with me in this extra long video. Please do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my work is helping you become a better trader. Also, please share my video with your family and friends. I wish you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.